Hey everybody, Larry Berman back at it this week. I'm still not quite fully sitting up regular, the back surgery and all, and so struggling through it, but getting by. Still able to be at my desk working most of the week, and what an incredible week it was. I knew I had to be in shape for what Powell was going to deliver this week, and ultimately, non-farm payroll weeks are always really exciting. So let's dig into the chart room and see what we learned this week. So in Powell's press conference, it wasn't a press conference, in Powell's talk and discussion about the balance between labor and inflation, which are the Fed's mandates, full employment and stable inflation. He talks specifically about their favorite indicator, which is the core PCE, the personal consumption expenditure deflator of GDP. When you look at GDP, you look at what everybody buys and consumes, at the economic level, personal consumption and investment, all of it. And then you look at what are all those things and what are their prices. And so, if prices are going up, is growth going up more and so forth. Anyways, this is their favorite indicator for measuring inflation. And he broke it down into three distinct categories of core inflation. So at the core, you have materials, right? So, throw out, as they say, food and energy, because that's volatile and it's not in the core. So in the core, you've got raw materials, which is not energy, but it's lumber. It's still basics. And you look at that and you say, the charts, and they're rolling over. And it's clear raw materials cost and supply shortages, and that acuteness is rolling over. Now, there's still food and energy to consider, and mom and pop still pay CPI, not core. But the reason he focused on the core was because of the wage element, really, and the owner occupancy rent and the cost of living in terms of your shelter. And so that owner's equivalent rent and calculation they do to factor cost of living is still growing pretty significantly. It's peaking, looks like it's going to come down, and probably will, but might be offset still, and still the combination of core goods falling and rents kind of staying up elevated, like continuing to increase, is still a concern. But both of those, he was pretty convinced that they were rolling over or have already rolled over. And then it's everything else, which is core services, the cost of everything we do, that isn't a good, isn't a product, it's a service. And the biggest component of that is our labor, cost of labor. So we focused in on that, and he talked very simple, like, okay, so I get my employment this week or this year, I get my raise, I get 5%, big union settlement, whatever, I get my 5%. But inflation's running at 8%, and you're upset about it, right? Because you're worse off. Your purchasing power is being eroded by inflation. If that happens 2 or 3 years in a row, that's where the way you're not happy with 5, you want 8, you want 9, you want a bigger number than the inflation. And so that is a big part of inflation expectations. And so the error that they had made in the 70s was that the recession that was caused early, they stimulated. Then you had the combination of Watergate and oil embargoes, and then you had this more permanent multi-year thing. And of course, it wasn't until Volcker Volckerized inflation and literally evaporated it by, extremely heavy short-term interest rates and really crushed it. we'll all know, everyone will know that story, or at least be somewhat familiar with it. So they don't want to make this mistake again. It's going to be very, very hard for the Fed to cut rates anytime soon. So higher for longer was the message, and the market didn't care. All the market heard was inflation's peaking. He didn't tap down on asset prices. Buy them, short cover them. And that's really what the rest of the week was about. And then you get the employment picture on Friday, and you got this uptick in average hourly earnings. And so they look at average hourly earnings, and Powell highlighted that. So here's our small uptick from expectations. You can see the trend is rising, but wage pressures, now a lot of this noise was throwing money at people, stop, start, the different job mixes. But effectively, what we've seen here is now a pretty material uptick from the levels that were pre-Great Financial Crisis and pre-COVID. Was getting back up to 3, but now it's pretty permanently elevated. And part of this is structural that he talked about. That was part of the average. I think there's 15,000 people a day that turn 65 in the U.S. or something. U.S. is naturally losing 200,000 workers a day compared to what's coming in. A month. And so you have this structural decline in the labor for the skill set of the economy, and therefore it's driving up wages. And that demographic balance is not going to get better for decades based on demographic trends. When you look at the employment cost index, and what are we paying, slightly different lens here on how it's looked at, quarterly numbers, tells you the same thing. The core inflation is going to be sticky up here as long as wage demands stay high. What this is going to do is going to put pressure on profit margins significantly. And the only way to tamp this down back to the 2 to 3% range is to literally crush the heart and soul of labor. There's no natural way for this to come down if inflation remains elevated. Wage demands are going to continue to persist. And that really, to me, is the go forward for the next year. And it matters a lot. So diving in a little bit closer, what are long-term inflation expectations? So Friday, long-term inflation expectations ticked higher. Yeah, not by a lot, but by 5-6 basis points. And that is interesting because at the same time, long bonds yields, right, inverse, actually rallied, yields fell. Now, initially on the headline print, bearish, and the bond sold off. By the end of the day, yields went out at the lows. To me, this is saying higher for longer. Fed's going to keep rates. Yield curve gets more inverted. What does that mean? More probability of recession. And all that adds up to the market just is not ready for a recession and the earnings hit that comes with it. When the U.S. 3-month, 10-year yield curves inverts historically, and you go back 50 years and look at this data, every time, without fail, earnings decline. Every time, without fail, we've got a recession coming. So it's coming. And to rip equities higher makes absolutely no sense at all, other than for a seasonal trend. So don't get lulled in to the narrative unless you're a very short-term trader and you want to trade to make Santa Claus happy so there's no coal in your stockings this year. So on the bull and bear pick of the week, all these market pullbacks and corrections. We saw a lot of bad news from an earnings perspective hit the cybersecurity sector this week. Several companies, Zscaler, Panalto, I think it was. There was CrowdStrike. There's a number of them. And initially the sector got hit, and by the end of the week kind of closed and turned okay, although we were a little bit weaker on Friday. Buying pullbacks into long-term thematic winners where there's a narrative and a story that, listen, if you don't think cybersecurity is going to be important like forever into the future, given the digitization of the world, you don't understand where the world's heading. So, buying pullbacks into what you like. Now, would I buy it here? If the market's correct and we're in a recession next year, are we going to revisit these lows? Absolutely. So the question then becomes, for the bulls in cybersecurity, how much do you want to own here? And if your maximum position in this thematic in your portfolio is 2%, have at least one in there now. If it gets back to the lows, let's add some more. You do not want to stop out of this thing. If it breaks to a lower low, you want to be adding, because this is a long-term winner on the bull side. So what do we look at in terms of the bear trade of the week? And so my bear trade of the week is a bullish way to play equities going forward. I love these innovator ETFs. P December just came out yesterday, or December 1st, rebalanced the portfolio. If we bought P December, PDEC, a year ago, that gave us exposure to the S&P 500, and it gave us a hedge of 15% downside risk. And look what it did over the last year. This is a one-year chart going back to the beginning of December. It was flat. Okay. What did the S&P 500 do going back to December? Down 10% year on year. Of course, at the lows, S&P down more than 20%, but the buffer, it managed that volatility. And that's the benefit of these option overlay strategies. So if you wanted to be bullish and you do like equities and you think I'm out to lunch, this is the better way to play it. Have a great week, everyone.